Good afternoon and welcome to Decarb Money Talks. Finance goes green, will it succeed? My name is Emanuel Rapsch and I am part of the Decarb finance team. The Decarb Future Economy Forum is a non-profit organization supported by the Foundation of German Business, E.ON Foundation and the German Institute for Economic Research, DIW, Berlin. It aims at providing a platform for societal discourse about the transition to a decarbonized economy. The theme of today's discussion is finance. We are very happy that Franziska Schütze has accepted our invitation to guide through the following discussion. Franziska Schütze is a research associate in the Climate Policy Department at the German Institute for Economic Research, DIW, Berlin. She currently coordinates the Sustainable Finance Research Platform. She co-authored several influential papers on the topic, for instance, about climate stress testing, the European Green Deal, and the EU taxonomy. In addition to these academic activities, she also has experience in the green venture capital industry. Before handing over to Franziska, let me just clarify some technical rules. Since this is a webinar, participants are muted and without video, but we are really interested in your feedback. So please do use the Q&A function where you can ask your questions and also upvote and comment the other questions. If you wish, you can also mention your name and that of your institution. This event is being recorded and the recording will be published on our website soon. It is now my great pleasure to hand over to Franziska.
Thanks a lot, Emanuel. Thanks for the introduction and also for organizing this panel today. I can see we already have a lot of participants in the room, in the virtual room. And yeah, welcome to everyone that's joining today. I look forward to the discussion. And yeah, I think we have great panelists and I'm sure we will have a lot of questions from the audience as well. So what is today's discussion about? Let me start with Greta Thunberg's speech, How Dare You, which maybe some of you might remember from 2019, where she cited the IPCC report saying that to have a 67% chance of staying below 1.5 degree temperature rise, the world had 420 gigatons of CO2 left to emit in January 2018. This number has now decreased to about 300 gigatons of CO2, according to the MCC carbon clock. So we see that, yeah, the carbon budget is decreasing rapidly, and the likelihood of staying below 1.5 degree is also decreasing. Climate change will lead to more heat, more drought, to storms, sea level rise, and yeah, will reinforce a lot of problems we already see today. And yeah, we are reminded of that as well through the daily news, yeah, from the war in Ukraine as well. So to mitigate climate change, a massive reallocation of capital is needed. And according to different projections, a global investment gap of at least 1% of GDP, but probably more, must be closed as soon as possible. And yeah, so this is the topic of today. The guiding theme of this afternoon is how to actually reallocate this capital and what processes we need and how how finance can deliver that, and what finance and what financial actors can actually do and what their role is. So I'm happy to introduce Tatjana Puhan, who is a Deputy Chief Investment Officer at TOBAM, which is a research-driven asset management company based in France. And she's also adjunct finance faculty at the University of Mannheim and a research fellow of the Hamburg Financial Research Center. Her former positions include that of the head of equity and asset allocation for the third-party asset management at Swiss Life Asset Managers, and she obtained her PhD in finance at the Swiss Finance Institute and Department of Banking and Finance at the University of Zurich. So welcome, Tatjana. And yeah, so maybe to start off with, from an investment perspective, I would like to refer to the letter by Larry Fink, the chairman and CEO of BlackRock, the world's largest asset management company, who started to address climate change in his letters to CEOs, which he does on an annual basis. And this came, as a surprise to many observers and also to companies, I assume. And he wrote things like, or sentences like, society is demanding that companies, both public and private, serve a social purpose, and that climate risk is an investment risk. And so Mr. Fink correspondingly announced at several occasions that BlackRock would take serious action via its future investment decisions. Tatjana, what do you think? What is this, or how would you define a sustainable investor, and what differentiates a sustainable investor from a regular investor? And did this initiative by Larry Fink have an influence on the investment community, according to you?
Yes, thank you, Franziska, and also welcome from my side. So maybe let me first of all just bounce back on what you just said about BlackRock and Larry Fink. So I believe when he's making such statements, it's probably not because he has turned into a climate activist from one day to the other. So I think we shouldn't sort of misunderstand the motives here. I think he's a very clever and tough businessman, and so I clearly appreciate also what he's built. But from my point of view, he clearly identified climate transition and climate change as a huge business opportunity, and also as something that his organization needs to push, because in a way their business model, which has little value added, would be threatened if they were not to sort of pick up this team. And so I think we should be a little bit aware of this to some extent. But now coming back to your question more directly, so I think first of all, a lot of things that let's say normal mutual fund managers, so beyond fund managers that manage what we call today impact funds or green funds or whatever, what these kind of normal mutual fund managers do is actually already not very different from what an impact fund manager would do. I think it's just that you probably you didn't make less of a fuss out of it. So just to give you an example, for instance, I mean, we had implemented policies to reduce our carbon footprint in our portfolios already since many years, and exclusion policies and many other things. And we did so because we sort of believe that this is sort of aligning, our values with our portfolio construction and our values that we believe we share with our clients. And so we didn't necessarily, promote this as something that is going to change the world, but again, it was fast in alignment with our values and the way how we build portfolios. Now, I think the challenges today is really to make sure that in a way what we promise that we do as a finance industry is really in line with what we can actually do given the data that we have, and given the models that we have, and so on and so forth. So I think here is actually a big issue, to the extent that a lot of people who claim today to be an impact fund or to be a green fund and so on and so forth, I think they're far from being able to actually really have an impact. Or there are important limitations to what they're doing. And I mean, maybe we can discuss a little bit more about this during our panel here. But I would just want to really highlight this, and it's a very important thing, I guess, that we are much more transparent about that and much more honest about that as a finance industry, so that investors get sort of aware of that, and that asset owners asset managers, banks, everyone, you know, we can make a joint effort together to sort of improve the situation, to work on those points, and that we can sort of come closer to improving the leverage that we have, you know, on changing something, because that is definitely clear, and that is something where we shouldn't discuss about. You see behind me the Matterhorn. So I'm a passionate mountaineer, and I see what happens to our glaciers. I see what happens to our Matterhorn because of climate change, because of global warming. So it's clear that there is a big issue, and it's clear that we don't have time to wait, to do whatever we can to actually act.
Thanks a lot for this first statement. I think there are a lot of points I would like to come back later on. So our next panelist today is Alexander Stomper. He's a professor at Humboldt University on economics and finance, and he's also responsible for the ISQD, a climate finance research group on impacts and imperfections. And his core research, he analyzes how the financial system interacts with other parts of the economy. And over time, he started to focus on risks associated with weather and climate change. And he received his habilitation at the University of Vienna and taught at MIT Sloan School of Management, as well as the Institute for Advanced Studies in Vienna. So welcome, Mr. Stomper, as well.
That's right.
And I would like to come back to Greta Thunberg's speech quickly, where she set a very different tone from Larry Fink that we just talked about. In her speech, she said, people are suffering, and people are dying, and entire ecosystems are collapsing, and we are in the beginning of a mass extinction, and all you can talk about is money. So, Mr. Stomper, what is your attitude towards money, and do you think we have to talk about money when we take climate change serious? And yeah, what difference can the financial sector actually make, in your view?
So do we have to talk about money? So I think that question needs to be asked at different levels. So I think that I wish we would not have to talk about money when we talk about climate policy. And maybe we should not be talking about money because there's you know, there's no planet B. And so basically, if you're talking about money, then you're talking about planet A, and if planet A gets lost, then there's no point, you know, even thinking about money, right? And so I think at that level the answer is clear. At the level of the individual, the answer is less clear. So I think about an individual like, you know, myself, and like we you know, the average person, we all have a certain amount of money, and we can do various things with it. We can spend it. We can spend it in a green or brown way. We can invest it in a green or brown way. And another thing we can do is we can donate it. So you can donate it to institutions that lobby for a more aggressive climate policy. And so the question, what should you be doing with your money, is completely non-obvious, right? Because you have various things that you could be doing. So I must say that I sense that there is a bit of a frustration behind the green finance project. And the frustration is that somehow politicians have not been acting fast enough to fight climate change. And now, you know, there's a bit of a magical thinking at work that has it that financial markets are going to solve this problem, you know, because politics failed. And so somehow the financial markets are going to steer capital into green investment opportunities rather than brown investment opportunities. But I think the reason I call this a magical thinking is because this is not the original purpose of financial markets. Obviously, you know, that is a role that financial markets can play, but we have to think hard about how this can be achieved. And it's not obvious that green investing is the best way to use money, for example, over donating it to groups that lobby for more aggressive climate change. I think one thing that I want to stress in what I will be saying probably during this panel is that industrial democracy is really important. So if you do invest in a green way, then one of the rationales is to get involved in industrial democracy.
Okay, thanks a lot. Thanks a lot. I think we all might need, maybe some of us need an explanation of what you think about, what you think industrial democracy is. Maybe you can explain that quickly.
Okay, so the reason I use the term industrial democracy is because it contrasts so well with the normal political democracy that we're having. Industrial democracy goes also by the name of corporate governance. It means that investors actually have a say, or they can have a say if they want to, if the system allows it, with respect to what firms are doing. And I think one of the rationales for investing in a green way is in order to have a voice in corporate governance and industrial democracy. And I like to contrast that with having a voice in political democracy. I just said that you could be donating money to groups that are lobbying for a more aggressive climate policy. And this contrasts with, I guess, the fact that a lot of companies who are burning fossil fuels are lobbying for a less aggressive climate policy. They are investing money. And how can that be? Somehow they think, or they argue, that this is in the interest of their shareholders. And green investors may decide to make investments in order to have a voice and say, no, that's actually not in our interest. What you're doing here is wrong in our opinion. And so I think that's a rationale for investing in a green way. And I call that industrial democracy.
Mm-hmm. Okay, thanks a lot for this explanation. And we also have Maya Hennerkes on our panel today. She's the Director for Green Financial Systems at the Climate Strategy and Delivery Department of the European Bank of Reconstruction and Development, also known as EBRD. Prior to this, she led EBRD's ESG work with financial institutions and private equity funds, and she promotes sustainable financial systems and the integration of climate, environmental, and social matters in investment decisions and management. Mrs. Hennerkes is a sustainable finance and ESG expert for many years, has a lot of experience with previous positions at the Inter-American Development Bank Group in Washington, D.C., and with Bloomberg in London. Welcome, Mrs. Hennerkes.
Hi, good afternoon from London. How are you? Thanks for having me.
Yeah, thank you as well. I will quote another speech today, the third one, a well-known speech of Mark Carney, the former Bank of England governor, in 2015, so already further back than Larry Fink, and he coined the term the tragedy of the horizon, which means that like financial agents or investors and also firms, as well as politicians, base their decisions on a rather short-term horizon, and that climate change is a more long-term issue. And so the question, the problem here is to really how to align these two different time horizons, the shorter term and the longer term considerations, and how to integrate more long-term problems into today's decisions. That's clearly a concern that I think is at the heart of the sustainable finance debate. And so, Mrs. Hennerkes, what do you think? What can policy and in particular regulation contribute? And as policy is still a national and in the EU and EU policy at the EU policy level, and yeah, has this limited time horizon, whereas climate and finance is a global and not restricted, it's a global business and not restricted to the short term. So how do you think we can deal with this this mismatch of time horizons?
Well, firstly, I want to say, and tragically, the time horizons are getting much shorter. We know that if we want to really achieve net zero by 2050, our emissions need to peak within 2.5 years, ideally, and they're still going up, yeah, at a global level. So this is a very short time horizon. We also know from ECB stress testing that most financial institutions expect climate risks to have an impact on their portfolio in the next future, meaning from within 3 to 5 years. So I don't think we're actually looking at that long time horizons anymore. That's just as a disclaimer. I do think that policy is one of the strongest drivers. I think we see that, for example, within the European Union context, a lot is moving right now towards more sustainability in our financial systems, because the EU has really started to put a lot of policy, a lot of regulations in place on the matters of sustainable financial reporting, on the matters of climate risks, on the matters of course, the EU taxonomy to define what is green, what isn't green. We also have, of course, the ultimate, with the European Green Deal, the ultimate net zero commitment. So policy is a massive driver. I see it translates into very practical things. I've seen a lot of our clients, financial institutions in EU member states, for example, because the SFDR, which is the directive for sustainability reporting, came along, they started to really reverse engineering, question their internal governance for climate matters, for ESG matters, and starting to really build up different systems internally so that they're able to identify the risks that they're running, they're able to capture the data, they're able to generate meaningful conclusions from the data, and then ultimately disclose on it. So I do think policy is a very strong driver. Specifically, the central banks have been on the case, because you cited obviously Mark Kearney, who's been one of the strongest voices on this topic. The central banks have been on this case for quite a while. You're probably familiar with the NGFS, the Network for Central Banks for Greening the Financial System. They had 8 members when they started off a few years ago. It's now 114. We know as investors that regulation is key to how we can invest. It can be really large scale, high-level regulation on things like, disclosing principal environmental social risks or disclosing principal climate risks. Sometimes regulation can also be something very specific, like for example, getting the rules right for how you tender out projects for renewable energy development and generation. So if the tenders aren't, we see that a lot in emerging market context, if the tenders aren't well done, it's very hard for an investor like us to actually then go and invest in the project, because there's a mismatch between what the tender says and what we identify as a bankable project. So yeah, hence also our approach. Obviously, EBRD, we are a public institution, we're a multilateral development bank, so we're investing heavily and completely under private market conditions, but we also have we're on the linkage with policy. So we also work with regulators, we work with central banks, we work with finance ministries, so that they set the universe up in a way that enables finance flows to be diverted from the traditional way of financing. There's a lot of different policy measures, of course, we can discuss later, but yeah, policy is a very strong driver. Maybe one last thing on the policy dimension. While I do believe strongly that policy is a massively strong driver, I don't think it should be an excuse for the private sector to sit back and say, okay, we'll wait for the governments to fix it, because we don't have time, right? Tatjana has said it very clearly. We're absolutely running out of time. And so I think from whatever our respective corners are, we need all hands on deck, whether it's academia, whether it's us as investors, we all need to figure out, okay, what's our contribution to tackling this? We can't wait for public policy alone.
Thanks a lot. Very interesting insights also from you. And we have another, not really a panelist, but an input from Tariq Fancy, who some of you might have heard of. He's a former investment banker, and after a Wall Street career in private equity, he became Chief Investment Officer in Sustainable Investing at BlackRock in 2017, a position which he resigned from in 2019. Since then, in a text called The Secret Diary of a Sustainable Investor, he has strongly criticized many practices of sustainable investing, qualifying them as greenwashing. And he's now the founder of a nonprofit organization, the Rumi Initiative, based in Toronto, Canada, which focuses on providing low-cost learning technologies to children in underserved communities. And we're happy that he agreed to giving a 2-minute pitch on his opinion on the subject. It was pre-recorded and it's going to be played now if everything works well. Yeah, looks like it. Okay, so we look forward to hearing.
Hi, my name is Tariq Fancy. I'm sorry I couldn't be there to join for today's panel, but I thought I'd offer a few thoughts that could hopefully help frame today's discussion. First of all, I think the question that we're all trying to figure out isn't whether the private sector and financial markets play a meaningful and critical role in the green transition. It's obvious they must. The question is how. Will we sort of sit back and wait for it to happen on its own? That clearly doesn't seem to be working fast enough. Will adding transparency be part of the solution, greater reporting and data and metrics? I think it's important to note that that's helpful, because after all, what isn't measured isn't managed, so measuring it is useful, but that alone is not enough. Adding transparency alone without actually internalizing the externality or correcting the market failure would mean that we're relying on the free market to self-correct for what is thought to be the greatest market failure in history. Where actually we may find some interesting stories is out of the pandemic that we just faced, right? Governments needed to find vaccines in record time. And they didn't just sit back and wait for the private sector to create them. They galvanized the pharma sector into action with direct R&D spending to businesses to help them get up the curve, multiple pre-orders from different vaccine makers. The US ordered close to 1 billion vaccine doses, multiple times the population, to ensure that many players had the incentives to rush and try to hit the finish line in record time, and expedited approval processes for all of that. For today, we have a giant green investment gap. We need more money. And on top of that, it has to be real money. It can't be just, funds with lots of secondary shares already traded in public markets that are painted green for a fee bump, because that doesn't actually do anything to close the investment gap. And as we look at this problem, we should remember that nothing should be off the table, including thinking about how the industry can be aided by governments doing just what they did in the pandemic to adjust the incentives and galvanize action at a speed much faster than we've seen so far. These are all important challenges, and I'm sure you'll figure them out in the next 90 minutes.
So thanks to Tariq for this input as well. So before we go to questions on the inputs that you, the panelists, gave earlier, I would like to ask you, the 3 panelists, would you like to react to the input of Tariq maybe right away? Have you heard anything where you think, yes, here I want to support? You talked a lot about transparency and also the role of the government, again, question we had already, and how the government might need to create a demand like it did for the pandemic. Yeah, I see Alex unmuted. You unmuted your microphone, and then Maya.
Yeah, thanks. Yeah, I think that's. I think so. So he talked about an investment gap, and what I would add to that is there's also a disinvestment gap, right? Basically, most investments are internally financed. So that means that firms are generating profits. They are not paying them out as dividends, but instead retaining these profits in order to make further investments. And so the question is this efficient? We should obviously think about how we steer new investment into new firms that are greener and that maybe are going to replace the old brown firms, but we also need to think about how the brown firms are actually going to shrink. And I think what just has been said is a drop in the share price looks like the firm shrinks, but that has no direct effect on the emissions the firm is actually producing. And so that's the kind of magical thinking that I was referring to. People tend to think that, you know, if the cost of capital of a firm changes, then somehow the world will be better. The cost of capital of a brown firm goes up, the world will be better, and not so fast, right? We really need to think about the process by which emissions are being reduced, and this will also require some disinvestment, I'm afraid. And I guess the other thing I want to say, because it has been said repeatedly that we lack time and we are behind the curve, and that's absolutely true, of course, but never underestimate the innovation that might be forthcoming. Also, maybe for removing carbon from the atmosphere, we need to create incentives for this kind of innovation, and so maybe we should not be too pessimistic. Maybe all we're talking about is really how bad will things become before they become better. Yeah, we may be behind the curve, and I guess most emissions scenarios are not really counting on carbon being removed from the atmosphere, but basically they are just saying, okay, where will we end up if we keep going, emitting greenhouse gases? But maybe that's not the full story, and so maybe this pessimism is overblown.
Okay, thanks. I like your stressing the innovation and innovative potential of companies and of technology maybe. So thanks a lot for that. I think Maya, you wanted to react to that as well.
Yeah, I'm going to say on purpose, very provocatively, I think Tariq may not be so convinced of this approach because of his experience at BlackRock. Because if you look at BlackRock's balance sheet, despite the beautiful words, it's extremely brown still. So that just for context. Look, I think where Tariq is right is that we have a market failure. And of course, as long as we don't have a price on carbon, that is sort of the original sin. Yeah, that's why when we do financial modeling for our investments, the price of climate change is not part of the equation. The same applies to natural capital and so on and so forth. So he is right in that sense that we're dealing with a market failure. That I agree with him. What I don't think is, and I think I kind of said it before, just waiting only for regulation to fix it, I think is not the right approach. And I think working for an investor myself, we can very much have a very strong impact in our limited means. So we have, for example, we're not investing in fossil fuels anymore. We have completely excluded all thermal coal mining, upstream, downstream oil, almost all gas, except with very few exceptions where we can demonstrate that there's no long-term carbon lock-in. We have a very strong environmental social risk management approach and so on and so forth. So as we can contribute to accelerating that, and we can, as investors, make a conscious decision to say, look, the limited funding that I have available, I will not keep alive the oil and gas companies. I will invest it in whatever renewables and so on and so forth. Of course, the regulators need to help us to put the universe in which we can invest in right, and we need to think about many things. There shouldn't be that many subsidies anymore for fossil fuels. They still exist in many countries. We should think about other policy inventions. But I disagree with him. I don't think that his experience is necessarily sort of the swan song to the sustainable finance as such, because I don't think he has experienced probably what is a real proper sustainable finance approach. That's my personal impression.
Thanks a lot. So I think, Alex, you raised your hand. You wanted to respond to that immediately, or?
No, I think Tatjana also raised her hand, so I'm going to step back.
Okay.
Yeah, maybe I just wanted to say briefly. I have so different things. So maybe first of all, when it comes to regulation, If you want, I pretty much like what Alex said in the beginning, you know, about this kind of industrial democracy and so on. So I pretty much believe also that this is something that we really need. And I think relying on regulation is not only going to make us, you know, arrive too late where we want to arrive, but also from what I've seen so far in regulation, it's actually been a big deception. So if I look at everything which is SFDR and so on, like I was looking forward to getting something very concrete, like EU taxonomy and so on, you know, something that will actually help us to sort of bring a certain standard into the market that will sort of bring clarity and also sort of help fight greenwashing. And what we got was actually something which is just like nothing. I mean, you read the text and you read it again and you read it again, and then you're like, okay, so concretely, they don't tell me anything precisely new, you know, so that really helps me to come closer to the target. And so you're a little bit left alone again, you know, so I personally feel it didn't really help us a lot. And so that's why I believe it's really about, you know, that you know, investors and researchers and so on, that, you know, we actually do something about it and we don't wait for the regulator. And I also think that, you know, the ways how we get there, they will be very different, of course. And I think we need to make up our minds about our objectives. And so I think for climate transition, for instance, I mean, there's a big discussion about it, right? Is it good to completely exit all fossil fuel investments or not? So shouldn't we maybe make, you know, certain parts of the, let's say, brown industry actually part of the game plan, because they have a lot of funds, they have a lot of research departments. And as shareholders or as bondholders, we actually have leverage on them. And so we can push them to change their policies. And certainly there will be some companies that are hopeless and we should just drop them and disinvest. But there will be others who can be actually really part of this energy transition, and taking all the funds away from them is potentially not the best way to really join up forces to sort of make this race together and to arrive there on time. And what I would also really like to sort of agree on with Alex is this kind of positive notion of innovation. So I really think that human beings have always been the most innovative at turning points. And when you look at you know, companies like I mean, for instance, like there's this company Synhelion, so they produce kind of fuel for actually aviation, which is sort of CO2 neutral and so on. So there are so many things going on at the moment that are really great innovations, I think. And I think that's where we need to push, where we need to invest more, and where, you know, be it governments, be it you know, special investment pools and so on. But I believe innovation, research, this is, you know, where we need to put our focus on, rather than reportings that maybe not so many people really need and understand, or any sort of, you know, kind of greenwashing exercises otherwise.
Okay, thanks a lot for your insights. I have a question directly related to that. So we heard, you know, we need to invest more into innovation, into new technologies, either in new companies and startups or growing companies. But you just mentioned also bigger companies and maybe also fossil fuel companies, or at least energy intensive companies, that they can be a part of the solution as well if they are willing and able to change. How do you as an investor identify companies in a sector, like in an energy intensive sector, for example? How do you identify the innovative, willing ones from the ones that are not on this path? I think because then it's a lot about forward-looking data maybe and targets and so on. So I would be interested in that as well.
Yeah. So first of all, I mean, you have companies, a lot of energy companies in countries, you know, that are partly state-owned, and in countries where, you know, the state itself, I mean, I don't want to shoot you against anyone, but I think it's very clear that in certain countries in this world, the governments are not perfectly, let's say, I mean, they're a little bit corrupt, to put it this way, and also the fact, and there are lots of kind of, you know, bribery scandals and so on around these companies. And it doesn't seem like, you know, these companies will actually be part of innovation, and they will be easily influenced by shareholder activism and so on. So I think for these companies, and this is also companies where we don't invest anymore, so where we actually exited, where we decided to go for a disinvestment approach. So this is pretty much in the emerging market space, for instance. It's the case that we sort of decided to rather go fossil fuel free. But in developed markets, I believe that there are companies actually that start to act now, and clearly it's not because they have turned, their CEOs haven't turned from one day to the other, you know, to the great environmentalists, and we need to keep this in mind. But here, you know, if you're a shareholder, if you're a bondholder, you can put them under pressure, and you can show them that, okay, if you make the next acquisition, you better buy some company or some startup, you know, that invests into renewables and so on. And these companies, they have huge war chests of cash, especially now, you know, with energy prices rising so much. I mean, these companies have a lot of money to deploy on actually investing into, you know, alternative fuels and so on and so forth. So, and this is something that you can obviously identify. And so for me in the developed world, you know, there are many examples like Shell, like BP, Total, and so on, who had to change already over the past quite a lot their policy because of activism, shareholder activism. And so, for instance, we work together with companies. So we work with some NGOs who kind of point out companies that start new carbon projects, for instance, now in this period of time where you would think like, who would dare, you know, starting a new carbon project? And what we tell them is, okay, look, for now, you're not into that business, or just with this very, very small amount of your revenues. Now you want to grow in that business. Think about it, because we will disinvest and we team up with our investors on the back of, you know, us. And these guys, they're really, really big investors. So they have hundreds of billions. And so you don't want to mess with these guys, you know, because otherwise you will have an issue. And it's more than simply a little bit, you know, financing costs that increase for you, but it will be really an issue for you. And so what we see is, you know, when we start this kind of dialogue and when we put pressure and we are certainly, I mean, we're not the only ones, right? It does have an impact and it does change something. And so it makes sense, you know, to really look into the details of these different companies and then sort of really try to interact with them.
Thanks. Yeah, that's an important point. I think, Alex, you want to respond to that.
Yeah, I wanted to ask, what happens to companies that you divest from? So the thing that I always fear is, I mean, you are obviously an activist investor, and if you get out, maybe basically that's for the worse, really. Maybe you should stay in the companies that are polluting, because maybe the next owner of these companies is going to care less about all of this than you are. So I think we need to keep track of what really happens. And I'm always afraid when basically investors with green preferences tell me that they divest from a brown stock. So maybe regulation in a way has to be part of the problem, right? Because there will, as long as an asset is valuable, it will be used. I mean, that's why it's valuable, right? And there will be an owner for that asset. There will be, you know, maybe the last brown person in the world will buy all the brown assets and use them. And the emissions of these assets might not go away, even, you know, if a lot of investors turn green and sell these assets. And so maybe we just have to have regulation, and there's no way finance will take care of the problem.
Yes, I think very good question. What happens if you divest? I think Maya and Tatjana, you both want to respond to that.
I hear this argument a lot. I'm not, while I can intellectually obviously understand it, I'm not a big fan of it, because the truth is, our financing as an investor is not infinite. So as long as I need to make a choice about my resource allocation, I think I need to go with the green one. I cannot justify to stick with a brown one just because maybe somebody else could come in and whatever. So my resources are not infinite. So I make a choice and I will choose as much as as long as there's green projects I can support, I will make that choice. Secondly, depending on the financial structures, you cannot ring fence normally the use of proceeds of your funding. So we have sometimes been able to, let's say, a big energy producer And when they decide, let's say, to issue a green bond, for example, we can invest in the bond, and then there is a specific use of proceeds that will support that energy company's green energy generation, while they may be still, you know, having some fossil fuel energy generation as part of their overall profitable activity. Sorry. So in that case, okay, I can ring fence my use of proceeds to the green activity. But what I don't want, because I have, you know, this concept from shareholder to stakeholder responsibility, I think as an investor, I need to take both serious, and I just don't think I can fully comply with that if I continue to keep it alive and you know, an economic activity that, in my view, should not be kept on a lifeline.
Thanks, Tatjana.
Yeah, so first of all, for me, you know, Alex, there are some cases who are just hopeless. So I think even if I mean, there's too much, again, you know, kind of government money in there from governments who just don't care, and regulation will not happen in these countries for the time being, because if you want, those people who are in the government, they take advantage of the profits of these companies and so on. So I mean, take countries like Brazil, take countries like Russia and so on. I mean, just, you know, forget, in a way you can forget about these, you know. So we have defined, if you want, these cases where we say, okay, forget about those companies, whether we stay in there or not, and whether we follow them or not, it will not change anything. And then we've identified companies where we say, okay, we potentially have a credible leverage, again, you know, when teaming up with other, like, really, like, the largest investors in the world. And this is actually something where I do believe, you know, we can change something, because as an equity holder, you can talk to the management, and you can have an impact on, you know, their policies and what they're doing, because the management, at the end of the day, I mean, it's delegated to them by the shareholders, right? And so that's why, you know, I think pretty much, you know, this shareholder activism can actually make a big difference, and is about ready to make a difference. And I don't think that we should, again, you know, these companies have so much money available, and they have so much also other resources available in terms of research, expertise, and so on and so forth. And I don't think we can actually afford not trying to do whatever we can to incorporate this money into, you know, our joint efforts to sort of find innovation and progress, and also to help these companies then in this process of climate transition themselves, you know, to transform themselves into providers, energy providers that might, you know, provide, for instance, fuels that come from solar energy and this and that and the other. So I think that's perfectly possible. So there's hope for these companies, but for the companies where there's no hope, honestly, I think, yeah, over time they will die out, because everything will switch to other energy uses and so on. And yeah.
Okay, thanks. I think, Alex, you want to respond to that again?
Yeah. So I think, yeah, I think that's a very reasonable way of approaching it, where you think about, like, what's my impact, and if I have impact, then it's maybe good to stay in a brown company, and if I don't have impact, then you know, I can exit as well. But, you know, I think this argument that, well, you know, in some countries there will be investors who hold these stocks, that's just a call for further regulation, in fact, right? Then you have to do something else in order to make life less good for these firms and investors, right? Like carbon border adjustment, stuff like that. Okay, and then another thing I just want to say is that assets usually, right, have a current use and an alternative use. What would you do with these assets if you would not use them in the way you're using them currently? And this raises a lot of questions of optimal industrial organization, right? It could be that a brown firm has a lot of assets that are also very useful, basically in the alternative use of them as you know, combined with green energy generation processes and so on. So it's clearly important to involve these firms in the transition. But I also think that a lot of times maybe we're not sufficiently imaginative when it comes to the alternative uses of assets. So like one example is, even if we stop burning oil, oil is going to remain useful because basically we need plastics. I mean, I'm a plastics engineer, so believe me, I worry about the spread of plastic waste and all that. But plastics are very useful materials, and they come from oil. So basically, oil is not going to become worthless even if we stop burning it. And I've seen papers where people actually, they say, well, is a financial crisis going to result from oil having a price of zero? And that's a clear case of a lack of imagination about alternative uses, right? So I think maybe if we would basically bring these arguments more strongly into focus, that would also alleviate a lot of concerns that investors have. Maybe some brown investors feel overly threatened by climate policy because they also cannot imagine that their assets might have an alternative use. And I guess that brings back the theme of innovation.
Thanks a lot for this thought as well. I would like to remind the audience that we have a question and answer section. And if you would like to ask questions to the panel, you can start writing your questions there already, and we will start with the questions from your side soon. And now I would like to actually ask the panelists a question a bit more in the direction of risk management. And so do you think that first of all, there's already enough information out there and comparable enough information to actually take these climate-related risks and transition risks into account? And do you think that most investors by now actually do this? And so that's already in the interest of investors to internalize and to integrate this data and these types of risks? Or do you think that regulation is strongly needed there as well to really enforce sort of this mechanism of internalizing this data?
I can give you the answer from the practice, from what I see. So, on the one hand, as EBRD, we've just issued our second TCFD report, so we're trying to figure this out. We probably haven't got the perfect solution yet, but we've learned a lot on the way. And then also, we have about 350 financial institutions clients, so I see what they do. So I can give you a little bit the perspective of both. I think most financial institutions, investors have understood that it's something to look into. We're all familiar, I think by now, at least at a high level, what the TCFD recommendations are. These are the Task Force for Climate-Related Financial Disclosures, which really looks at the reverse perspective. So we're not looking at what our economic activity, what's the impact on the climate necessarily. We're looking what's the impact of the climate on my portfolio and on my financial valuations, right? And I think there is a broad recognition now in the market, strongly pushed by the central banks, that it is something to consider. We're starting to figure it out. We're pretty good doing this already on sort of big type project finance type of deals or large scale corporate finance deals. We're struggling still with the large bulk of smaller SME lending or very fast trade finance, for example, where we have very quick exposures in and out. So we're working on it. We have now an internal system. We take a transition risk score and a physical climate risk score on every single investment. And it's something to be improved over time. I think our clients still struggle with it, but they're all starting to look at it. Regulation, again, is pushing it in certain markets because the disclosure regulations that have been released in several countries, namely the EU, but also other markets like Egypt, for example, they include, at least to a certain extent, some of the TCFD recommendations. So I would say it's a work in progress. There's an overall acknowledgement that there is probably something to it, but actually doing it, we still have to learn. I don't think anybody has the perfect valuation model for it yet.
Thanks. Yeah, and Tatjana.
I don't know what Tatjana, what do you think?
Yeah, so I think two, three things. So first of all, I think in terms of pricing this in, it's super tough because I think, of course, we like people try to make the best effort and so on, but we should be aware that everything is based on a lot of uncertainty. Because obviously climate models, even if you put the best climate researchers on it, I mean, they have a lot of uncertainty, they have a lot of parameters to be estimated and a lot of things, a lot of assumptions and so on. So I think we should be, first of all, very clear about what we can actually potentially really achieve with these scenarios and with, trying to price in somehow climate transition. So probably what we try to price in today is needs to be changed over time and so on. So that's one thing. And that's also why I think that markets currently, I mean, I'm talking about public markets, I think they're far from having really priced in, this kind of climate transition and climate risks and so on. So neither physical risks nor regulatory risks and so on. And also what climate transition itself will cost for us. I mean, these investments that are necessary. I mean, the last 2 days, there was actually a very interesting conference at the National Bank of Austria. And there was also the topic of, it was about inflation, and there was a topic about, inflation actually triggered by, this whole climate transition and so on. I think, the wider impacts that climate transition, climate risk is going to have on our economies and on in total, I think it's very, very, very difficult for us to capture. And so now I come to my second point. So that's why I personally I think it's very tough, for these scenario things and so on that are required by these working groups or that they say you should do, because essentially you're doing an exercise where you have so many blind spots that probably it makes sense, especially for, let's say, long-term investments in real assets that you do to do that kind of exercise. But for instance, for, the portfolios that we are managing, I mean, we are in the public market space, we are we have a turnover of, let's say, 100% of our portfolio in a year. So, of course, we can do these scenarios and so on, but in the end of the day, the question is whether, this is going to matter that much after all, or what this is really telling us. So for me, this is not yet something that, people have fully thought about. And then there's another thing. So what you could try to do is maybe in this more like public market spaces, you could try to think of approaches where you kind of try to create sort of hedging portfolios. Okay, so hedging portfolios to the extent that you try to hedge, let's say, physical climate risk, or that you try to hedge this kind of climate transition risk. So there if you want empirical approaches how to do that, but also here there are big caveats to that. So if you want to, if you just read the papers, that describe for you the sort of econometric approaches of how to build hedging portfolios and so on, that's all super nice and great. But then if you really try to implement this, you get into issues of finding the right data to use, so that you can actually measure sensitivities, that you get sensitivities that are more or less stable over time. And especially for like climate transition risk, it's not completely clear, what would you use, for instance, as a proxy for that and so on. So, once we start to get really into the nitty-gritty details of, trying to put these things into place, you will actually realize a lot of issues, that come along with this. And so we already spent quite some time actually on kind of thinking about and working on these kind of hedging portfolios. And so it's not straightforward. It's a bit dirty, probably also. And in reality, you need to make some pragmatic choices and so on. So just to be transparent and sort of also realistic about this, but there are potentially also ways of, addressing these topics for public, let's say, publicly invested entity in public equity or in public, kind of listed fixed income and so on. So so there's, there are different ways of how you could think of this as well.
Thanks a lot. That's very interesting. I think we have a few questions already in the chat, so I will take up a first one here. The first one was, since we talk a lot about regulation and policies, is there any approach regarding negative emissions? So how, I think, Alex, you mentioned it as one, or someone mentioned it as one innovation area of innovation. Do you have any opinion or stance on how to push for negative emissions?
you know, I think, should I try and answer this? So I think what we need a reward for removing emissions from the air, obviously. And so I know that in academic research, people are thinking about incentive mechanisms there. But of course, this reward will have to come from government money in the end. And so there's tied into this is obviously there's a need for policy making again. And yeah, so
does it need to come from governments, or can it also come from companies who want to offset their emissions?
I mean, we have obviously emissions trading, but that is about the emissions, the current emissions of firms, not about the past emissions. The problem is if we want to remove emissions that have already occurred, then we will have to talk about past emissions and create incentives to you know, essentially create payoffs for doing that. And I think that's what's currently lacking. And there's clearly a need for government policy here.
Okay, thanks. Yeah, Tatjana or Maya, do you have any insights from your perspective on negative emissions as well?
I think, I mean, from my point of view, this is not, I mean, I mean, it depends on the context of the question. So, but I mean, probably if you have a company that has negative emissions in an approach where you try to reduce your CO2 emissions because you want to align your portfolio with certain temperature projections and so on, I mean, your portfolio is going to love this company, right? So, yeah, so it's not a problem at all, actually. So I don't necessarily see that there needs to be a special approach, but maybe I just didn't get the question right. So
we calculate emissions for each project. So whatever the outcome, the better it is, the more we like it. I mean, if they have GHG emission saving towards the benchmark, or if they actually produce negative emissions, that's just sort of, you know, brings it a bit down. So we measure, we have an evaluation framework that we call transition impact. So basically we measure the impact of a project, the positive impact of a project. So the better the project, the more that would score highly on our own. That's our own evaluation scheme. But other than that, I don't know why it would differ from any other investment.
I mean, you are taking a flow perspective. Do you realize? But we need to take a stock perspective. Climate change is not being caused by the flow of emissions. Most of it is being caused by stuff that we've put in the air already. And as long as we're just taking a flow perspective, we will not solve the problem. I'm afraid, right? I mean,
yeah, I think, yeah, maybe it's a question of really how much we need to take out of the air at one point, and then this netting emissions of individual companies is not enough anymore, and then maybe for this case the incentives are still lacking, you know. Okay, I think we can have a look at the second question. What about the problem that many clean, green or sustainable companies do not receive their finance via capital markets? How could their access financial means or their access to financial means be improved next to capital market options? Tatjana, I think.
Yeah, maybe Maya's I mean, closer to this, but I could also say something. But maybe Maya, do you want to go first?
Well, again, if they mean with capital markets, literally capital market instruments, bond issuances, etc., there's obviously alternatives to that. You know, there's green lending, there's there is green mortgages now. We have basically almost a green version of almost any, even retail, even credit cards. You can find them green, whatever that means, and whatever is behind the claim, one would need to scrutinize. But I guess whatever source of finance, there is theoretically some sort of green version available nowadays in the markets. So it necessarily does not have to be a green bond issuance as such. I think what's more the question is, how do you become as a company sort of bankable now or creditworthy for anybody to lend to you or for an investor to invest in you, whether it's equity investment or whether it's a lending structure. And here, of course, this is one of the hurdles that we have in climate finance, that the more innovative the company is, the harder it is for a risk management of a lender or an investor to actually understand what you're doing and to measure the risks. Therefore, sometimes this is a hurdle of getting finance to where actually a lot of the impact would be generated. This is one of the very well-known hurdles that we fight with in climate finance. Yeah.
Mm-hmm. Thanks a lot. Yeah, Alex.
Yeah,
Tatjana.
So the premise has been that green companies do not get funding in the question. And I guess the question would be, why not, right? So there must be, if there is a demand for the product that they are offering, because you have green consumers, then it would be surprising if these firms cannot get funding. So maybe the problem is that there's not a sufficiently reliable demand for the product. And that's possible because maybe there's, for example, regulatory uncertainty, and you know, there's essentially, you don't really know whether the greenness, the priorities of consumers, governments, and so on might shift, and so maybe the way to get these companies financed is to have robust demand for green products, and so maybe in the end it is a matter of policy uncertainty. If we knew that the economy is going to go green, then there should be demand for green products because these are the future, and a lack of this demand maybe just indicates that we're not certain enough that the economy is actually going to be greened. And there's another case for regulation and political commitment.
Mm-hmm. Yeah, I think that reminds me of the point that Tariq made in his input on the example of vaccines, that the government created a demand for this, and maybe sometimes in some cases this might be needed to kick off sort of the investment and the innovation there.
And actually,
sorry,
maybe just to say, so I personally I don't share really the view that that access to financial markets is particularly bad for these kind of companies. So I think actually it's better today for them than for other kind of startup companies, because you know, just to give you an example, so if you're a big investor and sort of you commit to some sort of net zero policies and so on, then by, for instance, funding projects of these kind of startups and so on, you can actually sort of get closer to your net zero target. So you have actually an incentive to put your money into this, even if you're not completely sure that it's a 100% profitable investment for you, but it's going to help you, you know, to get closer to your sort of climate related targets that you have, you know. And so so I think there are lots of incentives today actually for investors to provide money to startup companies as VC investors or any kind of, you know, this type of investing. And so I think today they have better access to financial markets or to funding, let's say external funding, than they ever had before.
Okay.
Just to add on to that, again, from the perspective from the practice, I fully agree with what Tatjana just said, 100%. If a green company, so what I do sometimes see is that a company, if they only sell themselves on the back of being green, that alone doesn't fit it. That alone doesn't do it, of course. They still have to be financially robust and they have to be bankable. Yeah, sometimes we have this bankability gap where companies, you know, or, you know, the latest climate tech funds, that you know, they can look wonderful on the climate side, but then, you know, they still need to comply with all the other expectations that any financier has towards a company that they would fund, from, you know, track record of their management, from the financial strengths, from whatever, you know, governance issues, whatever, so on. So that we cannot mix. So sometimes a green company may not be funded, not because they're green, but because there are other issues, yeah, despite the fact that they're green. And then again, the point I made, so in my world, we work a lot with what we call now concessional finance or blended finance. That's an attempt to bridge that bankability gap where we have, for example, I can give you an example of a project I was involved in many years back. So we did the first large-scale CSP, concentrated solar project in Chile in the Atacama Desert. At that time, I'm talking like over 10 years back now, there were no commercial banks that were willing to put financing up for such a project because they couldn't, they had no way of calculating the risks that were involved. They didn't know the the technologies well enough. They just couldn't calculate it, so they wouldn't invest in it. So then what we do is, in those cases, we call them first mover projects. We try to structure something where, with a limited amount of public money, for example, from a development bank or from a donor country, you structure like a first loss tranche or some way of de-risking, so that there is some insurance to a commercial lender to come in the second layer, so to speak, and they feel a bit assured that the risk is a bit mitigated by somebody else possibly taking the first loss. So there's a lot of experimentation that we do in the field of climate finance to get, sometimes with the use of minimum concessionality, we call it, hopefully the least amount of public money necessary to then bring in the most possible amount of public money. But this is now really, I'm talking mainly large scale projects here. So that may not necessarily be available, for a small startup company.
Thanks, yeah, very interesting example. Alex, you want to respond to that?
I think we've all been arguing that finance is not really the problem for green firms. But now, since I've been following this discussion and thinking about it, I can now actually imagine that there are some firms where finance is the problem. So, for example, suppose that greening the economy requires also some brown investments. So let's say you want to exit coal, and maybe that requires that you enter gas, not in this country, right? But maybe in African countries. Then the question is, can these firms actually get funding in order to invest into gas, or are lenders saying, well, gas is actually brown, and they're not looking at it relative to coal, but they're looking at it in two absolute terms. And then, I've heard that some firms have problems getting funding, in this kind of situation. So I cannot assess the extent of the problem, but maybe the practitioners have an opinion on this.
Yeah, it's a tough question. We would really need to crunch some numbers, I guess, to make an informed opinion about that. But just intuitively, I would say, I don't think we have an overall lack of funding in the market for general economic activity. So if somebody cannot get funded, there is a gap somewhere, there's a hurdle somewhere, which can be a policy gap, it can be a risk management gap, it can be, something related to the country where they're in, expropriation risk or God knows what. So usually we can identify what the specific hurdles are, and then either you can work on eliminating them or you can't. But I don't really think there's a shortage of funding in the system, and there's certainly not yet a shortage of funding for traditional economic activity and fossil fuels, because they still get quite a good they get quite a good chunk still, I think. And I think this is also not really our concern. I think our concern is that as a global community, we have committed to the SDGs and we've committed to the Paris Agreement. And what we need to think now is, if this is our benchmark and if this is sort of our guiding star, we need to figure out how to get there. And in order to get there, we need to redirect huge amounts of funding towards those economic activities that are in line with the goals of the Paris Agreement or with the SDGs more broadly. So I think this is more what we need to worry about, not so much what we do with some fossil fuel companies, to be honest.
Okay, thanks a lot. That fits to the point that we don't have a lot of time left to actually do these investments.
But I just wanted to say, Paris Agreement, for instance, one condition so that you align your portfolio with the Paris Agreement is that you exit all fossil fuels. So all fossil fuel related issuers. So again, you know, now coming back to this discussion we had earlier about climate transition and how we might want to maybe still incorporate this industry into the climate transition. Yeah, I think that's actually forcing you to make this choice, and otherwise you cannot say you're sort of in line with the Paris Agreement and so on. And so yeah, so I think this kind of regulation is sometimes a two-sided sword in a way, you know. So that is a comment on the side.
Yeah, thanks. Good point. I think I will take two questions in one go, and then you can decide which one you would like to respond to. One was, if all investors would prefer green assets to brown ones, wouldn't green assets become overvalued, which would in turn draw investors away from green assets? I think goes a bit into this question, is there a green bubble? And which problems does that maybe lead to? And the other one, when assessing greenness of a firm, is only current greenness used or also future greenness? If yes, future greenness is risky. How is this risk to future greenness of a firm measured? And how would this enter a portfolio optimization? And so it's more related to this question of forward-looking information and how to incorporate that.
Can I
tell you all? Sorry, Tatjana, you go.
Yeah, maybe two quick answers to both from my side. So for the first one, there's actually a nice paper of Pastor and Stambaugh. So what they do is they model actually a new equilibrium where you sort of incorporate green preferences of investors, and where they show that initially to get to this new equilibrium, you will indeed sort of have kind of green assets kind of outperforming, if you want, brown assets, but in equilibrium, in the end of the day, you have a negative alpha resulting for green assets over brown assets. So I refer to that paper because I think personally it's very nice. For the second question, what I would want to say is that future greenness is incorporated. So for instance, if you model temperature trajectories of companies, if you want to do Paris alignment and so on and so forth, what you do is you do incorporate the fact that there are certain companies that have committed to certain reductions of their CO2 emissions path over time. And so you're not assuming, that it's an ever increasing sort of function, but you do incorporate actually their reduction targets into what you plug, into your temperature models in terms of emissions for these companies. So it is actually something that plays a role, because of course you want to give incentives to companies to go down that road and to sort of say, okay, today we're maybe still polluting a lot, but we really want to reduce that a lot. And so you give them an incentive to do that, because this will already show up in your investment model, and it will be incorporated. So that's definitely part of it.
Yeah, on a very practical level, because of course, what can we make a company that we lend to or invest in, what can we make them do? Well, that's the life of our investment or the life of our loan, right? So it depends really what the tenor is, if it's a lending or if we take equity, how long we stay with the company or the financial institution. It always has a future component, because we don't only look at, let's say, year-to-year GHG reduction, emission reductions, for example. We also look and every day more so with the climate risk discussion, at what's the climate corporate governance of an FI, of a financial institution, or of a fund, or of a company. What's the ESG governance? How do they organize? How do they manage those risks? And that's obviously always a long-term perspective, because we expect them to do all those things at a certain level throughout. We also have a lot of repeat business with clients. So then we know exactly, okay, we may give them a 5-year loan, but they will come back for another 5, and another 5. So that prolongs the perspective. But it's never only a snapshot in time of the moment where you approve and disperse the loan. It's always across, at the minimum, the lifetime of your loan or investment, and often beyond, because you have an ongoing relationship.
Thanks a lot. Yeah, very interesting. Alex, did you want to respond to that? I saw your hand, but now...
I'm in the lucky situation where the practitioners have already mentioned the relevant academic reference. Maybe I could now add some, finance professor comments to that. And you know, the short version of it is that this analysis of Pastor and Stomper, it talks about tradable assets. And you know, what I'm kind of missing is what would happen if some assets, let's say brown assets, become non-tradable in the sense that they are held by investors who are stuck with these assets. Then these investors would need to get basically some risk sharing going with the other investors in the market, and that will then also affect the expected returns of the green assets. And you know, then you know, the green assets that are the least correlated with the brown assets, they become more valuable, and the green assets that are relatively correlated with the non-traded brown assets, they become less valuable. And so, you know, in fact, there's interesting effects, you know, on different types of green assets. It's pretty complicated. I'm sorry.
No, thanks a lot. Yeah, good point. The last question I think we'll take is a bit more, general question, going back to the degrowth kind of discussion. Please comment on a strategy. I'll give you a short version. Please comment on a strategy that will lead to degrowth and a more equitable distribution of goods to survive the coming crisis. So it's more about do we actually need less growth and more equitable distribution.
So I'm not an expert in degrowth, but it's clear that growth will always depend on the way you measure it. And so I would think that this has to start with coming up with suitable measures of growth. If you take into account destruction of our physical environment, and if we redefine growth, and maybe if we price destruction of our physical environment, then you know, you might get something that looks like degrowth under current measures of growth.
Mm-hmm. Yeah, good point. How do we actually measure growth? And should we, maybe, how should we measure it? Does anyone still want to respond to that or have any thoughts on that?
Maybe just very briefly on that. So I personally, I think it's, I still believe it's not a good idea to always call for the government and regulation to sort out things fast, because I think they have heavily failed in the past, and they show us every day how much they fail on solving things. So I don't think that's the, you know, probably what we should be waiting for. Yeah, that's my only input, and it makes me a bit scared, you know, that people call out so much for regulation and for government direction and sort of restricting corporations and so on. That makes me a bit scared, actually.
So since I've been calling for regulation a lot, I now feel addressed, and I actually want to say that one type of government regulation that I would call for unabashedly is for companies to stay out of influencing the political process. So, you know, I guess if we would have that, then my other calls for government regulation would also be less, you know, strong.
Mm-hmm. Yeah, very good point as well. Yeah, so thanks a lot. I think we have to come to an end with this discussion. It was very interesting points from your side, from very different perspectives, from more research perspective, from practitioners' perspective, from more private and more public oriented banking perspective. So I think that gave a lot of good insights on how to steer maybe investments, or how to reallocate investments into a more green and sustainable direction. And I thank you all a lot for participating, for joining this panel. And yeah, thanks also to Emmanuel and Henriette for organizing this panel. And yeah, I think I'll hand over to Emmanuel. To Henriette. You might want to say some last words.
Okay, thank you very much for the summary, and thank you very much for the moderation, Franziska. So this is the end of the Decarb Money Talks Finance Goes Green. Will it succeed? Part of the Green Macro series organized by the Decarb Future Economy Forum. The next event will tackle the adjacent topic of green monetary policy. Just follow us on LinkedIn, Twitter, or YouTube, or have a look on our website, decarb.world. For more input on today's topic, you may have a look on the podcast future.economies, which recently featured a discussion on sustainable finance with today's moderator, Franziska, and also Sebastian Rink. Now, we cannot end this event without thanking all the persons who made it possible, of course. On behalf of the Decarb team, and especially the finance team at Decarb, which equally comprised Henriette Weser and Peter Paul Dimke, I would like to thank again very much the three speakers, Tatjana Puhan, Maya Hennerkes, and Alex Stomper. Thank you very much for this very extensive and diverse discussion, which I found very interesting. We express our warm thanks to Franziska Schütze, who did a magnificent job in managing this discussion and directing it towards many different important points in the subject. We thank a lot Tariq Fancy for sharing his insights with us through his video. Then we thank the Foundation of German Business, the E.ON Foundation, the DIW Berlin for the help and support in preparing this event. We thank the Center for Sustainability of the Hertie School of Governance, Berlin, for technical support. We are indebted to Michael Börde, professor at Humboldt University of Berlin, and Ottmar Edenhofer, professor at Technical University of Berlin, as well as director of the Potsdam Institute of Climate Impact Research and the Mercator Research Institute of Global Commons and Climate Change, MCC, Berlin, who gave us valuable support during the invitation process. We thank Paulo Krischak, Deutsche Bundesbank, for helpful advice on the content of this event. We also thank the MCC Berlin and the Zoe Institute for Future Fit Economists for their general support. Finally, the finance team wants to thank all the helping hands at Decarb, which unfortunately cannot all be mentioned here in detail, but which the event could not have taken place without. Last but not least, we thank you, dear listeners and attendees, for this panel discussion, for your interest, and for sharing your time with us, be it from here, be it from far. If you're interested in joining us, do not hesitate to contact us. We thank you for sharing our purpose with your friends and colleagues, and we hope that we may succeed together in concretely moving towards a more sustainable financial theory and practice. Bye-bye.
Thank you. Bye-bye.